Good evening, and welcome to Quantum Network News, your source for news and analysis from a conservative perspective. I'm your host, Robert Saint. Tonight we'll be discussing how the Harris campaign plans to tax U.S. citizens $4 trillion over 10 years. Now, there is an ongoing debate over this Harris proposed tax plan and its potential impact, I believe catastrophic impact, on small business and your personal finances. The Harris campaign plans on instituting this tax on high earners, people worth $100 million or more. But how many government plans are kept at that high benchmark? You know, the benchmark that they're initially set to. Well, you know the answer to that. None. When they originally set the income tax, it was only supposed to affect the top 1% of earners. Now it affects the top 50%. Well, let's get into the details, folks, because tonight we're going to be discussing the scariest of all proposed tax plans: unrealized capital gains. Now, unrealized capital gains refers to an increase in the value of an asset that has not yet been sold. For example, if you bought a stock for $100 and it's now worth $150, well, then you have an unrealized capital gain of $50. Well, the gain only becomes realized when you sell the asset. The Harris campaign has proposed taxing that very unrealized capital gain. They believe that this is their way of increasing tax revenue and addressing wealth inequality. However, this concept comes with several potential problems and challenges. Let's get into those. Number one, there's going to be valuation issues. It can be difficult to accurately value certain assets, especially those that are not publicly traded, like a private business or rare collectibles. There are going to be liquidity concerns here. Taxing unrealized capital gains might force people to sell assets or borrow money to pay the taxes on value they haven't actually accessed yet. Can you imagine that? Market volatility is going to come into play here. Asset values can fluctuate significantly. A tax on unrealized gains might be based on a temporary high, a high that does not reflect a long-term value. There's going to be administrative complexity. Implementing and enforcing such a tax could be logistically challenging and costly for the taxpayer. The economic impact is going to be felt from this. It might discourage long-term investment, risk-taking, everything that will slow down economic growth. There are going to be increased selling pressures. Investors might sell stocks to cover tax bills on unrealized gains, potentially leading to increased market volatility. A downward pressure on stock prices could ensue. This could be particularly pronounced near tax deadlines or at the end of the year. There are going to be changes in investment strategies made, of course. Long-term buy and hold strategies might become less attractive, as investors would no longer benefit from deferring taxes by holding on to their appreciating assets. There could be a shift towards investments that generate regular income, like dividend stocks, rather than those focused on capital appreciation. This will lead to reduced market liquidity. If investors are discouraged from holding stocks long-term, it could reduce overall market liquidity. This might lead to wider bid-ask spreads and potentially more volatile market movements. There's going to be an impact on growth stocks. High growth companies that reinvest profits rather than paying dividends could disproportionately be affected, as their value is largely based on unrealized appreciation. This might shift investor preference towards value stocks or established companies with steady earnings. There are going to be valuation challenges for publicly traded stocks. Determining fair market value for tax purposes would be straightforward. However, for thinly traded stocks or private equity, valuation could be complex and contentious. This is going to affect IPOs and capital formation. The prospect of being taxed on unrealized gains might discourage private companies from going public, potentially reducing the number of IPOs. It could also make it harder for startups to attract early-stage investors. This would affect the broader ecosystem and of innovation and capital formation. Now, luckily, there are going to be some constitutional questions posed. This may not qualify under the 16th Amendment as income, so you may not be able to get by with that. There are always going to be fairness concerns. Some argue it's unfair to tax paper gains that could disappear before they're realized. There will certainly be an impact on your retirement savings. For many people, unrealized gains in retirement accounts represent a significant portion of their wealth. So if you apply this to retirement accounts, it could significantly change how people save and invest for retirement. And don't think that if you don't have a retirement plan, that you've got nothing to worry about. Anything that's bad for the government, it's usually bad for its citizens. And if they completely screw up the economy by taxing unrealized capital gains, it's going to lessen the survivability of Social Security. And that could affect your retirement plan. International competitiveness. If implemented in one country but not others, it could lead to capital flight or make that country less attractive for investment. It can make our country's stock market less attractive to international investors. This would potentially lead to capital outflow. Now, there will be political feasibility issues. Such a significant change to the tax code would likely face strong opposition. There are going to be market timing issues. The stock market's inherent volatility could create various situations of added complexity where investors owe taxes on gains that quickly disappear in market downturns. This will lead to calls for complex loss carryback provisions. There's going to be an impact on index funds and ETFs. These popular investment vehicles might need to adjust their strategies to account for tax implications, potentially affecting their performance and their appeal. And on the topic again of complexity in the market, new financial products might emerge to help investors manage their tax liabilities, adding layers of complexity to the market. There's going to be a potential for market overreaction. The initial announcement or implementation of such a policy could lead to significant market volatility as investors adjust their strategies and portfolios. This would cause broader implications for the stock market. Now, while some argue that the market would eventually adjust to a new tax regime, others contend that it would fundamentally alter investment dynamics in ways that could have long-lasting effects on capital markets and economic growth. Proponents argue that taxing unrealized gains would help close loopholes that actually allow wealthy individuals to accumulate vast fortunes while paying relatively little in taxes. They believe that unrealized capital gains could be implemented with careful rules and exceptions to address some of these concerns. Critics, however, maintain that the practical and economic drawbacks outweigh the potential benefits, and that there are better ways to achieve tax fairness and raise revenue. Well, I hope that this explains some of the dangers of such a tax proposal, unrealized capital gains. Folks, when you go vote in November, I hope that you really consider what you're doing. It doesn't just affect you and the United States. It affects the entire world. Well, thank you for listening tonight to Quantum Network News, your source for news and analysis from a conservative perspective. I'm your host, Robert Saint.